Equity Market Update, April 2020. In April 2020, Indian markets were up approximately 14.5% month-on-month after correcting approximately 23% in the month of March 2020. The key drivers of rebound in markets were global fiscal and monetary stimulus announced by major countries, positive news on favorable trial results of a particular medicine in the US for treatment of COVID-19, and relatively low number of positive cases in India compared to other countries. The rally in equities was broad-based, with mid and small caps also rising sharply in line with large caps. Most sectoral performance was positive, with healthcare, auto, and oil and gas outperforming significantly. Globally, equity markets also rebounded in April 2020, and most major indices globally delivered positive returns. FPIs remained net sellers for the second month in a row, albeit the pace of outflow slowed significantly. FPIs sold equity worth $0.9 billion in April 2020, after selling $8.3 billion a month ago. Total FPI's equity outflows in the first 4 months of CY20 have been $7.3 billion as against inflows of $9.8 billion during the corresponding period last year. Net inflows in domestic equity-oriented mutual funds stood at INR 11,344 crores in March 2020 compared to net inflows of INR 9,958 crores a month ago. For FY20, total inflows in domestic equity-oriented mutual fund stood at INR 67,035 crore. As on 30th April 2020, Nifty 50 was trading at price-to-earnings multiple of 19x based on FY21 estimated earnings and 14.8x based on FY22 estimated earnings. While multiples remain attractive, in uncertain times like the current one, limited reliance can be placed on price-to-earnings multiples for gauging valuations, as earnings are difficult to predict, especially for FY21. In our opinion, Indian market cap to GDP and price to book value are better indicators of valuation of the overall market in the current scenario. As of end April 2020, Indian market capitalization is approximately 60% of GDP, a level seen last post-correction during the global financial crisis in 2008-2009. Price to book value has also corrected sharply over the past couple of months and is now trading at significantly lower than its long-term average. Further, it is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has reduced significantly, and it is now below the 10-year average. This further indicates that equity markets are attractively priced. Markets thus hold promise over the medium to long term, in our opinion. Further, the Department of Investment and Public Asset Management Secretary has mentioned that exchange-traded funds are going to be a less preferred route for divestments going forward. This should lead to better valuations of PSUs, as regular supply of shares through ETFs was a big overhang on their share prices. In view of the above, where risk appetite permits, investors should use this deep correction to their advantage by increasing exposure to equity funds. At times like these, perceived risk is higher than the real risk. Thus, there is merit in increasing allocation to equities in a phased manner or in staying invested, as the case may be, for those with a medium to long-term view and in line with individual risk appetite. It is advisable to invest one's total investable surplus of risk capital in 2 to 3 phases over the next few weeks or months. One significant tranche should be deployed now, because markets are down 20% from the recent highs, and the other portions can be invested over a few weeks or months. Historically, it has been observed that investments made in tough times and around periods when FPIs are large sellers have yielded strong returns over the medium term. Significant delay in containment of coronavirus, adverse global events, sharp rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.